We'll start as ever with the economic calendar. That can be found on the MarketPulse website. That's marketpulse.com, and you can click on the economic calendar just here, where you'll see all the upcoming economic events for this week. I will add a filter on and just cover those which are relevant to the currency pairs which we are looking at today. So please do just bear with me 1 second. Again, this is just specific for us, but of course you can have whichever events that you wish to have, even if it's just one or two. Just say you're a cable trader, you may only be interested in UK and US economic events as an example. So I think that's narrowed it down to everything which we are looking at. I'm only interested in medium and high impact volatility events at this moment in time, just so we can narrow it down a little bit further. And here we have the economic events that are impacting us this week. Of course, it's worth noting that there are greetings, Carlos, as well, who's joining us from Ecuador. Welcome. So there are other political events which are clearly dominating, of course, over the course of this week and over the course of a number of months in many cases. The trade tariffs which came into effect last week between the US and China is, of course, of notable importance, and we have seen certain amount of risk off in anticipation of this. The question now being, will Trump follow through on threats of an additional $200 billion in tariffs against China, or is this selling a big game but not having the ability to follow through? I think that's going to be a question on everyone's minds, because you have to assume that if he's going to come back with a big old $200 billion in tariffs, and it doesn't look at this moment that China or the EU or anyone else is backing down, then this does start to escalate into a full-blown trade war, which is what we're worried about. Greetings also to Jose in Miami. Nice to see we're getting people from a number of different countries, so welcome again. The other big story politically as well is Brexit. For those of you in the UK, you're probably sick to death of hearing it right now. For those of us in the UK talking about it, I think we're probably sick of talking about it as well. But there has been some interesting developments which was shaking the pound yesterday. And some of you may be confused as to why the two developments had such different impacts on the pound, despite being seen as broadly, or appearing to be broadly, similar. Now, naturally, we can only speculate as to why this is. We had two resignations over the past 36 hours at this stage. First one was Brexit Secretary David Davis. He's been leading the negotiations in Brussels with his counterpart Michel Barnier. This came after Theresa May and her cabinet agreed on an outline for what it hopes to agree in the future deal with the EU. It's looking for a customs partnership, particularly on food and agriculture, which would help resolve the Northern Irish border issue and keep the two closely aligned, keep the border open effectively, and without putting a border between Northern Ireland and the rest of the UK. It also means that the services sector is open to exploring ambitious trade deals elsewhere. The customs arrangement wouldn't prevent the UK agreeing customs arrangements elsewhere, but it would handcuff it slightly to the rules within the EU, assuming it wants to continue to trade with the EU in the future. And these are some of the stipulations surrounding this is something that the Brexiteers, or some Brexiteers, have deemed unpalatable, unbearable to an extent, especially those who want to completely break free from the EU and its rules, expand and look elsewhere for trade deals, and remove itself ultimately from the rulemaking and the jurisdiction of the ECJ. That's the European Court of Justice. So we had the resignation of David Davis, a staunch Brexiteer, late on Sunday night UK time, and that was followed yesterday afternoon by the resignation of Boris Johnson. Now, you'll notice that these had different impacts on the pounds. Initially, actually, the pound weakened in response to David Davis's resignation. We did see a rally after this, and I think this was driven by the belief that this was potentially a sign that Theresa May was going down the road of a softer Brexit, which is ultimately seen as pound positive, close ties with our largest trading partner, minimal impact on the economy and on jobs and on growth. However, when this was followed with Boris Johnson's resignation, then this looks less like just a softer Brexit approach. But then you're starting to head down the road of full-on mutiny. This is a sign that this isn't just one Brexiteer who's become disheartened with the way things are going. This is two very, very prominent Brexiteers. And then you start to hear a lot more discussion around how many more people are going to resign, if any. What's going to be the follow-up consequences? Is there going to be a leadership challenge for Theresa May? Are we going to see new elections? What could those elections mean? So these questions have really started now coming out since Boris's resignation, more so than David Davis's, although they will have been discussed. Again, this is what we are assuming based on the market reaction is the reason behind the reaction. All we can do is speculate at this stage, but that appears to be the approach people are taking right now on this particular matter. And all this disarray and all this uncertainty, political uncertainty, the prospect of Theresa May being toppled and replaced by someone who's seen as more of a Brexiteer could be negative potentially for the UK economy in the near term, which again would explain why it'd be negative for the pound. I think ultimately, while we're looking for reasons to explain these movements, it's worth remembering that we're talking about 50 to 100 pip moves, so we're not talking big, dramatic swings, and I think that's important. So the currency remains volatile. It remains quite sensitive to Brexit news, especially news of this kind. But ultimately, we're not seeing these massive post-Brexit swings, and I think that's important to note. So they're the two big political stories this week. Donald Trump is touring the EU, so we are going to hear a lot about NATO this week, NATO contributions from different countries. He is going to be here in the UK, where I believe there's going to be a 40-foot baby Trump balloon released over the city as part of an anti-Trump protest, which at the very least will be entertaining to see. But I think it's going to be an interesting week from Trump's perspective, visiting a lot of people, and I think there is a lot of fears that he's going to withdraw from NATO at some stage, so we should have a much better idea on that this week as well. In terms of the economy, we've had some economic data already at the start of the week. We had this new GDP data this morning. Now UK GDP is released monthly. It's released, so this is the May figure, so it's released around 40 or 50 days after the actual month end, largely in line with expectations on a month by month, but also on a year by year basis. We did get some weaker manufacturing and industrial production data, which was a bit of a concern for May. I think the numbers that people really want to now see are the summer numbers, particularly on the retail perspective. We saw that the BRC's like-for-like sales for June were 1.1% higher overnight, but we have had some data also from credit card companies like Barclays who are suggesting that we have seen a significant increase in consumer spending. Now, that's not a surprise. We are undergoing something of a heat wave in the UK, or what many people in the US or other parts of the world would just deem a normal week, but we're not typically that fortunate with weather over here. So with the World Cup happening, people going out more, England actually doing well in a World Cup, which is very unusual. We are expecting this to have a positive impact on consumer spending and therefore the economy in the second quarter and start of the third quarter, which will be very interesting to see. Whether it can be sustained, I highly doubt it at this stage because there is plenty of underlying weakness. In terms of the rest of the week, we are very reliant on central bank speakers, the likes of Bostich, Williams, Carney, etc. We've also got the Bank of Canada rate decision on Wednesday, which is going to be very interesting because, as you can see, we're expecting a rate hike from 1.25% to 1.5%. So that should be very interesting. Very strongly alluded to this rate hike, and there is potential for a second this year. They have been a little bit cautious, the Bank of Canada, so far this year, but at the same time, very much consistent in their messaging, I think, to an extent, with regards to wanting to raise interest rates. The economy has had some ups and downs, which has potentially delayed this a little compared to what it wanted to do later on last year. But like I say, market's very much anticipating a rate hike now on at the meeting on Wednesday. We've also got the ECB minutes on Thursday, which will be interesting also, given that what came out of the last meeting was the fact that the ECB is going to extend its QE program till the end of the year at half the pace, which is only a few extra months. But then it said they won't be raising interest rates at least the middle of next year, which seemed to be taken as a dovish message from the ECB, but I really personally don't see it that way. I didn't expect the ECB to ever consider raising rates before the middle of next year. But the fact that it's laid this all out for us, basically a 12-month path, is quite out of character to an extent. I know some previously they have said for the foreseeable future or anything like that, which suggests at least a 12-month period. But for them to lay out the end of QE and already start talking about rate hikes, I thought was quite interesting, and if anything was quite hawkish. So we'll see how that materialises. We also have US CPI inflation data on Thursday. Again, this is not the Fed's preferred measure of inflation. However, it is the first release of inflation for the month of June. So it tends to have still a relatively significant impact on the markets. Then we've got Chinese trade data on Friday, as well as University of Michigan Consumer Sentiment Index. And for those of you who like oil, the oil rig count. So as you can see, relatively quiet day. Weak on the economic releases front. There are some worth noting and worth paying attention to, especially if you trade those currency pairs. Political stories aside, which I still think are going to dominate this week, the Bank of Canada really does stand out as the main economic event of the coming days. We'll now move on to the charts and just hope these technical issues that I was having on my laptop have subsided. And as you can see with the euro dollar, we came back towards these kind of 115 levels, and we have found support around here recently. You could see that when we were approaching that last low, there was very little momentum with the move, as you can see down here. So it wasn't entirely surprising that we did start to run into some support around here. Same goes for the attempt after that. Interestingly though, and it's still early days, which is why I've drawn a dotted trend line on there, more of a preliminary speculative trend line here, but this is a lower high from the previous attempt. If we continue to trend lower towards these kind of 115 levels again, this would suggest to me that momentum is still very much with the bears. That what we're seeing right now is consolidation, not even really correction territory, and would suggest to me that there is potential for a little bit more downside below 115 here. Again, though, we are back in correction territory of the longer term trend move, which I still believe is very much intact. So a break below 115, we'll see an interesting test of these kind of 114.50s. But really, anywhere between these kind of this kind of 50 and 61.8 fib, I think starts to become a very interesting potential support zone. I'm looking around, say, kind of here around the 113s, price support and resistance, historic support and resistance, slap bang in between a 50 and 61.8 fib. I'll be very interested to see what the momentum indicators are telling us then, assuming we get to these levels. Right now, bit of consolidation, but it's not looking particularly bullish at this stage. If we break above the previous high, then that's an entirely other story, because at that point, you've got a lovely little double bottom having formed here, and a break through those kind of that previous peak of 118.50 would suggest that potentially we have a nice push to the upside on the cards, potentially, and that's a nice 350 pip sized double bottom as well. And as the textbooks say, if you've got a 350 pip sized double bottom, gives us a possible price projection of 350 pips to the upside, which takes us back to 120, these kind of 122 levels, which, as you can see here previously, was a notable area of support. Again, getting ahead of ourselves, but it's worth being aware of the levels both to the upside and the downside in these consolidation patterns. Sorry, just had to have a little sip of water there. one of the downsides to doing these videos on my own. Means I'm constantly talking for around half an hour or so. So yeah, I mean, cable is very much very similar. Let's get this onto a daily chart where it starts to make a lot more sense. Same as Eurodollar, long-term uptrend. This is a post-Brexit uptrend though. It's worth noting this is the post-Brexit lows here back in October 2016. We've retraced almost 50% of that already, which just goes to show how big a correction we've seen in the dollar in that time. Now we are starting to lose some momentum. You can see that we had the sharp sell-off here. We've lost momentum all the way down. We've got this descending channel. But more importantly, we look at the momentum indicators at the bottom, MACD moving average, MACD histogram, even the stochastic. Momentum is just not with the move anymore. That's not to say that it can't go lower, but it would, if momentum does not pick up with the downside, then that makes me significantly question just how much further down this will go. Very interestingly, and I must stress that this does not always work out like this. This is one of those one-off occasions when it does work out so perfectly. But we came to these lows of 130.50 and we literally touched it to a micro pip. That was the absolute dream touch here from that double top move all this time ago. That was a double top break that we broke below here back at the start of May. We did actually hit the price projection level there at the end of June, like I say, to the pip. So that move has now completed, and that's another reason why I think there is potential that the correction may have potentially completed as well, or at least largely so. That was always going to be an aggressive, ambitious target or projection, but now that that's been fulfilled, I'm very interested to see how markets are going to trade around these kind of 130 levels. 130 again coincides with a 50% retracement of that move, momentum out the move. That's not to say we can't see another test to the downside, but I'm very intrigued to see how we react around that 50 fib at this moment in time. If we break above that falling channel, then that could suggest that at the very least we're in correction territory of the move from the previous high to the previous low, or alternatively, it could mean that we are seeing a correction to the upside. But I think a break of there would suggest to me that things in the near term are looking quite bullish for this particular pair. If we move to the downside, I will absolutely want to see momentum join the sell-off, which is something we haven't had as of late. I wish there was something more I could add to Euro Sterling, given that it's been a couple of weeks since the last webinar, but there really isn't. It's consolidating. The Euro and the pound are trading very much in unison to many extents right now. We have been gradually trending higher, primarily due to the what's happening in the UK with Brexit specifically. So that's been helping it to gradually trend higher. But these are slow, painful moves. I mean, when you think that, almost a month ago now we were back at 87 and now we're at 88 and change. We're not talking huge moves here over the course of that period. So not a pair I'm particularly excited about or I'm going to spend any more time on, because we're very much consolidation bound right now. Yes, we've broken through those previous highs, which confirms to me what I said, that we are in a gradual uptrend here. But that doesn't mean that we're going to be breaking these 90s. We may gradually trend upwards there over the coming weeks back towards these kind of 90 highs, which is the broader range. But that could take days, it could take weeks, it could even take a month or two if that is going to materialize. And there's not even any guarantee of that, because you can see here we may have broken through those previous highs. Look at the size of that upper wick on this candle here when we initially did. That was very strongly sold into. Then we'd had another jab at it here. We got to 89 and that was strongly sold into, and now we're back at these. There's not too much appetite for a strong upside move here. So I think we're very much dragging in this pair. And for me, that's not particularly interesting, if I'm honest. The Aussie dollar versus the US dollar remains interesting. The Aussie dollar can be seen as something of a risk proxy, which may partly at least explain why it's being so out of favour over the course of this year. The US dollar, in many cases, especially over the last month or two, was seen as the safe haven currency. We saw a lot of flow into US Treasuries. So US Treasury yields were going from around just over 3% on the 10-year down to below 2.8% in times of risk aversion, which naturally benefited the dollar, because in order to buy Treasuries, you need dollars. So that was benefiting the dollar. The yen widely is still seen as more of a safe haven currency, but recently favour has been more in towards the dollar, as you'll see shortly. And the Aussie, on the other hand, is kind of seen as your risk barometer. It's a high yielding currency. In times of risk on, then you tend to see it favoured. It's also a good China proxy as well, because Australia exports so much raw materials to China. If the Chinese economy is seen doing well, which is typical at a time when the global economy is doing well, but we did actually see it, I should stress, after the financial crisis, thanks to a load of fiscal stimulus in China. But China right now doing well is seen as a proxy for it's seen as a global economy barometer to an extent. And that's another reason why the Aussie dollar suffered, because we are currently seeing a trade war unfolding between the world's two largest economies. And if that's going to be damaging for the Chinese economy, then you would typically expect that to be damaging for the Australian export of raw materials, the market for Aussie raw materials, and also therefore the Chinese economy. But then also that also hurts the Australian dollar. There is potential that, of course, China could jump in with some fiscal stimulus again to support the economy if we do enter a time of economic slowdown, and they have shown a willingness to do that even in recent years. Even last year, we saw evidence of that. Not to mention monetary stimulus. We saw a cut to the reserve requirement ratio recently, which they sold as something as providing the opportunity for banks to reduce their debt loan ratio, their debt to equity ratio. But I think, given the timing of it, the fact that it came in a day before some US tariffs were implemented, suggests to me that it's very much an economic stabilizer. So they have shown a willingness to do so. But then we are also undergoing a transition in China right now, whereby there is a hesitation when it comes to more debt. We're actually trying to reduce debt at this moment in time. There's a hesitation to providing fiscal and monetary support. So I don't think they're going to be as quick to pull the trigger, I guess, as they were in the past, and they are going to try and ride this out as much as possible. But in the meantime, any threat to the Chinese economy is a threat to the Australian dollar, and I think that's really what we are seeing play out right now, because the Australian economy is doing okay. The Australian Central Bank is very quiet. The possibility of a rate hike in the near future looks very slim. So it doesn't seem to be this that's driving it. And this isn't a new story. So this isn't a sign that the Australian Central Bank has become more dovish by any stretch. This is not a new story. I really do think this is very much China and trade war related. From this, we'll move on to dollar CAD. Apologies if I'm slightly distracted. I'm sat at a computer in one of the offices in London, and we have helicopters and planes flying past, celebrating the RAF's 100 years. So I'm very slightly distracted. I will try and crack on though. So yeah, dollar CAD I still think is very interesting. We had this nice little break higher back in the middle of June. We ran into this kind of resistance around 133, 134, which was prior resistance as well, which I'll show you right now. You can see here was support and resistance when we had this head and shoulder pattern, which broke, which was a nice indication of a break lower. And so that was prior support and resistance, and you can see that it's now provided resistance once again. We have rotated off there, clearly seen some profit taking of some kind, and moved back into this territory, which was most recently resistance. back towards a kind of 130, 131 territory, and already we're finding some support. Now, again, as always in these situations, and I will drop to the 4-hour on here as well, we're looking for signs in support zones that this is just a corrective move, and that we are going to see a rotation back. And as you can see, when we've approached the 130, 131 already, we are seeing momentum start to slip out the move. Stochastic here making a higher low. MACD, Instagram, and MACD moving averages making a higher low as well. So this is a sign that we are finding not only running into some support around this previous area of resistance and potential area support, and you can see the 200 and 233 day simple moving averages there, which have done here and here, providing possible support also. But also momentum is falling out the sell-off. So that suggests to me this is potentially going to see some form of bullish rotation in this zone, and may have already. I think by coincidence I might have one of the best views in London of this particular display. They're just flying in from the right hand side of my window and going straight past the building. It's quite phenomenal, I must say. Sterling CAD, we saw a lovely retracement off that 50 fib, which came around 177.50. That coincided with previous area of support, now turn resistance, which was a level we highlighted nicely. Ultimately, though, what we want to see, from a technical standpoint at least, is a break below that 200 and 233 day simple moving average, because what we've had here is it's found support on these levels since trading above here. We've then seen a break below the rising trend line here, which starts from September of last year. That was the first indication really that we've got a bearish move appearing. We also had this head and shoulders here, which was also a strong indication, and that gave us this projection as well, if you remember rightly, back towards these kind of 171 levels, which played out very nicely also. And now we've had a correction. Now a rotation off the 50 fib is technically a lovely little rebound, but what we want to see next is a break of this kind of 172, 173 level. The 200-day simple moving average is where we found support initially, and I think a break of this, these two moving averages would be a lovely bearish signal down to the downside. And again, then you're looking for potential initial support around 170.50. But I think really, if we're breaking below 172 and 170.50, we are looking a more significant correction. And I'm looking at these kind of 167, 168 levels, which look extremely interesting based on where we've traded previously. Again, apologies if I'm a little distracted. I did not know at the time of filming this webinar that we were going to see such an incredible display of right outside this window. I'm trying to get some pictures, and you can check my Twitter later on as I go, because it really is quite impressive. And I'll also ask some of the many other people in the office if they'll send me theirs as well, so that I'm not being too distracted. Again, another technically very interesting chart. The Kiwi dollar, US dollar is just very nice. Like, we broke below the previous lows and we've come back towards that 66.50, 67 level, which we highlighted in a previous webinar, I believe, because it was previously, and we will go back once again, previously a level of interest, level of support when we broke above here. And again, technically very, very nice. We've found support around them, we've rebounded higher, but we've run into resistance around 68.50, 68, which is the most recent area of support, which again, we've now rotated off, which again is technically significant resistance. If we are coming back to the downside, then that starts to look bearish again, and a break below here again. From a technical standpoint, this starts to look very bearish, and I'm finding it very difficult right now to be anything other than bearish, especially when you add into the fact that we had this nice strong sell-off here. We had a bit of a corrective move into the 38.2 fib, and from there we had a nice straight sell-off and a new low. Yes, we've made a higher low on the stochastic and the MACD moving average, which again is which is potentially a sign that we are losing momentum. But price doesn't confirm that right now, and I don't think this is a particularly strong signal. I think that more is a reflection of just how sharp this initial sell-off, and you can't continue that over a longer period of time. So I'm not too concerned about this particular pair right now. Now we'll move on to the yen pairs, and I'll keep it in the same order as always. And we'll start with dollar yen. And this is what I was alluding to earlier. Dollar yen, yes, the yen is typically more of a safe haven currency, particularly when we are talking about safe haven driven by something US related. So you'll remember when US North Korea spat was really getting heightened, and it was very much the yen which was the favoured safe haven currency, and the dollar was almost second or third, or at times it was even not seeing much safe haven flows at all. Whereas more recently with this trade spat, whether this is because US is perceived to have more leverage, or whether it's more a reflection of the fact that other central banks are not as seen to be as far along the path with monetary tightening. I'm not too sure, but what we are clearly seeing is more favour for the dollar. So we've got these rising lows here ever since the start of April. But what's significant is we are making new highs, and I think that's quite important. If we break through this kind of 111.50, I think this starts to look very bullish indeed, because this is now a long-term area of resistance, prior area of support as well. A break below here was a technically very bearish signal. So equally, a break back above would be just that. And if we are breaking above those levels, then personally, I'm looking towards these kind of 113, 114 levels once again. So I can't stress enough how, in my personal view, if we break through these 111.50s, then this is starting to look very bullish indeed. The penultimate pair we'll go on is sterling yen, and I apologise for running over. This is partly due to me starting late, and also partly due to the distraction which is happening outside the window right now. Sterling yen, I think, is really, really nice from a technical perspective. We've not broken back above the Ichimoku cloud with regards to the lagging line, which is seen as the confirming indicator in Ichimoku, despite the fact that price did actually at one point test it back here. But you can see that further behind, we actually came off that level and rotated lower. So we've actually been in bearish territory for a lot longer than that from a lagging perspective, which was quite interesting. Since then, we've continued to trend lower, if not gradually to begin with. More recently, though, we failed to make a new lower low, and I think that was quite important, quite significant. And we also had no momentum in the move as well. Now we're approaching this level, which could give us a very clear bullish or bearish, very clear bullish signal, and potentially a bearish signal as well. So what we have here is around this kind of 148 level. We have the 55.89 moving average. We've got the previous area of resistance from back at the start of June. We've also got the top of the Ichimoku cloud and the 38.2 fib of the move from these highs to these lows. So like I said, very significant level here. And if we can break above there, for me, that is a very, very bullish signal that we should be keeping a very close eye out for. And if that breaks in, I think that would be a lovely one to break. Then that could potentially signal a much more significant move to the upside. Initially, we'd be keeping an eye on these 200, 233-day simple moving averages, but the 50 fib here starts to look very interesting, especially considering it coincides with a nice big round number like 150. But even, to be honest, that is where we'd also see the test of the lagging line against the Ichimoku cloud as well. So that would be one to watch out for. I would love to see that 148 level broken and the Ichimoku cloud and everything else fall in line with it. Finally, we'll wrap up with euro yen, and in much the same way as with dollar yen and potentially sterling yen, this is broken through the cloud. This has broken through previous highs. We failed to make a new low. This is looking very interesting once again. We were looking for lagging line for confirmation, and perhaps that will come around these kind of 131s. 131 is the next interesting level to the upside. Its prior resistance is the 50 fib of the entire move. If we are going to rotate lower, that would be an interesting level for it to happen on, because it's also where the lagging line will start to test that Ichimoku cloud once again. So if we break through this level, on the other hand, then things start to look very interesting indeed. Yes, 132 poses an interesting test from a price action perspective, with it being a 200 and 233 day simple moving average. But by that point, the lagging line is back above the Ichimoku cloud, possibly. And I think that would be, for me, a very bullish signal. So as you're seeing, in a number of cases, dollar yen, sterling yen, euro yen, all of these are potentially going to give us nice bullish signals, in my personal opinion, hopefully in the not too distant future. Apologies again for running over. I really hope that was thorough. I hope that you all gained something from that. Aside from that, we'll be doing another one of these in a couple of weeks' time. And until then, I wish you all the best of luck with your trading. Thank you very much for taking the time out to join us today. And again, I wish you all the very best of luck and speak to you again very soon. Thank you very much.